Section 1. The shock nobody saw coming, $180 billion, gone in 72 hours, all-time highs. Then sudden reversal, the blind spot. What every analyst missed, the real trigger. Hidden in plain sight, $180 billion. That's how much wealth evaporated from the gold and silver markets in approximately 72 hours. Not over weeks, not gradually. 3 days, gone. Gold was sitting at all-time highs. Silver was surging. Every analyst on television was bullish. Every headline screamed higher prices ahead. Central banks were buying. Retail investors were stacking. Institutions were accumulating. And then it snapped. If you owned precious metals during this collapse, if you watched your portfolio bleed red for days straight, if you wondered how something that seemed so certain could reverse so violently, I need you to listen very carefully. Because what happened wasn't random. It wasn't unpredictable. And it definitely wasn't what the mainstream financial media told you. While they blamed profit-taking, while they pointed to dollar strength, while they offered surface-level explanations that explained nothing, something far more mechanical was unfolding beneath the surface. This crash followed a blueprint, a precise, documented sequence of events that has triggered every major precious metals collapse for the past 5 decades. Same setup, same trigger mechanism, same devastating outcome. And the most unsettling part? The warning signs were visible for weeks, in publicly available data, in positioning reports, in market structure, right there for anyone who knew where to look. But almost nobody looked. By the end of this video, you'll understand exactly what triggered this collapse, why it happened so fast, why almost everyone was caught off guard, and most importantly, how to see the next one coming before it wipes out your gains. Because this pattern will repeat. It always does. The only question is whether you'll recognize it next time or be blindsided again. Welcome to the silent economy. Let's break this down. The paper market, where prices are really determined. Leverage dynamics. How $1 controls $100. The two armies. Commercials versus speculators. The 5-phase cycle. Crash mechanics decoded. To understand why this crash happened so fast, you first need to understand something that most precious metals investors never learn. The gold and silver prices you see quoted on financial websites, on trading platforms, on the evening news, those prices aren't determined by physical supply and demand. They're determined by paper markets. Futures exchanges. The COMEX in New York. The London Bullion Market Association. Markets where contracts representing gold and silver trade in volumes that would be physically impossible. Let me give you a number to illustrate this. On a single heavy trading day, paper gold contracts representing 30 million ounces can change hands. The entire world produces approximately 100 million ounces of gold per year. One day of paper trading can equal 4 months of global mining production. For silver, the disconnect is even more extreme. Paper trading volumes regularly exceed annual global production in a single week. This isn't controversial. It's not conspiracy. It's simply how commodity futures markets function. And it creates a dynamic that most retail investors completely misunderstand. In these markets, there are 2 primary groups of participants. Group 1, the commercials. These are major banks, bullion dealers, and producers. They typically act as market makers. When speculative traders want to buy, commercials sell to them. When speculators want to sell, commercials buy. They profit from the spread and from positioning advantages. Group 2, the speculators, hedge funds, managed money, retail traders, momentum followers. They're making directional bets. They think prices will go up, so they buy, or they think prices will go down, so they sell. The Commodity Futures Trading Commission tracks these positions weekly and publishes them in the Commitment of Traders report. Public data. Anyone can access it. Now here's the critical framework. Every major precious metals crash follows the same 5-phase cycle. I've studied crashes going back to 1980. The pattern is remarkably consistent. Phase 1. The foundation. Fundamental narratives turn bullish. Inflation concerns rise. Currency debasement fears spread. Geopolitical tensions escalate. Money begins flowing into precious metals. Prices start climbing. Phase 2. The momentum build. Rising prices attract more buyers, media coverage increases, analysts raise price targets, retail investors enter, speculative long positions grow week after week, commercial short positions expand to match. The market becomes increasingly one-sided. Phase 3. The extreme. Speculative positioning reaches historical extremes. Managed money net long positions hit levels that have preceded every major crash. Everyone who wants to buy has already bought. The market is maximally stretched, but prices are still rising, so nobody worries. Phase 4. The trigger. Something shifts the momentum. A news event, a technical breakdown, a coordinated selling wave. It doesn't matter what specifically. What matters is that selling begins and leveraged longs start exiting. Phase 5. The cascade. This is where the violence happens. As prices fall, leveraged speculators face margin calls. They must sell or deposit more capital. Most sell. Their selling pushes prices lower. More margin calls trigger. More forced selling. The crash feeds on itself. Because these positions are leveraged, often 10.1, 20.1 or higher, a 5% price drop can wipe out 50% or more of a speculator's capital. Forced liquidation becomes the dominant market force. The crash continues until speculative long positions have been substantially unwound, until the weak hands are flushed out, until the market resets. This is mechanical. This is predictable. This is how it works every single time. Let me prove it with 4 historical examples. 1980. Silver $50 to $10, the original crash blueprint. 2006. Gold drops $150 in weeks, pre-crisis warning. 2011. Silver loses 35% in days, margin hike massacre. 2013. Gold flash crash, 400 tons of paper selling. Example 1. January 1980. The Silver Implosion silver. January 21st, 1980. The price hits $49.45 per ounce, an all-time record. Adjusted for inflation, that's well over $150 in today's money. Let me walk you through the 5 phases. Phase 1 began in the mid-1970s. Inflation was destroying purchasing power. The dollar was weak. Nixon had closed the gold window. The fundamental case for precious metals was overwhelming. Phase 2 accelerated through 1979. The Hunt brothers of Texas began accumulating massive positions. Other speculators followed. Silver rose from $6 to $49 in roughly 12 months, an 8x gain in 1 year. Phase 3 reached its extreme by January 1980. The Hunt brothers and their associates controlled an estimated 100 million ounces, half the world's deliverable supply. Speculative fervor was at levels never seen before. Magazine covers featured silver. Taxi drivers discussed their silver investments. The crash setup was complete. Phase 4 arrived when the COMEX changed the rules. Margin requirements were raised dramatically. Position limits were imposed. Liquidation-only trading was implemented for large speculators. Phase 5 was devastating. Silver fell from $50 to $35 in a single week, down to $15 within months, eventually bottoming near $10, an 80% collapse from peak. The Hunt brothers lost their fortune. Retail investors who bought the top were financially destroyed. An entire generation of precious metals investors was traumatized. The 5-phase pattern verified. Example 2, May 2006. The gold pre-crisis warning gold. May 2006. The price hits $730 per ounce, the highest level in 26 years. Momentum is strong. Analysts are bullish. Phase 1 had been building since 2001. Gold bottomed near $250 and began a steady climb. Fundamental concerns about the dollar, about government spending, about monetary policy drove accumulation. Phase 2 accelerated through 2005 and early 2006. Speculative interest surged. ETFs had made gold accessible to millions of new investors. Managed money, long positions expanded rapidly. Phase 3 reached its extreme by early May 2006. COT data showed speculative net long positions at record levels for that era. The market was heavily one-sided. Phase 4 triggered on May 12th. Prices reversed sharply. No single catalyst was obvious, but the setup was in place, and selling began. Phase 5 unfolded over the following weeks. Gold fell from $730 to $560 in less than 2 months, a $170 drop, over 23% in a matter of weeks. Most analysts were confused. The fundamentals hadn't changed. The dollar was still weak. Deficits were still rising. Why the crash? The answer: mechanical liquidation of extreme speculative positioning. The fundamentals were irrelevant to the short-term price action. Gold would eventually recover and go much higher, but those who bought the May 2006 top had to endure significant pain first. The pattern repeated. Verified. Example 3. May 2011. The Silver Massacre. Silver. April 28, 2011. The price hits $49.82 per ounce, matching the 1980 all-time high for the first time in 31 years. The excitement was palpable. Social media was filled with predictions of $100 silver. This time is different. Arguments proliferated. Central banks were printing. Debt was exploding. Silver to the moon. Phase 1 began after the 2008 financial crisis. Silver had bottomed near $8. Quantitative easing, money printing, and currency debasement fears drove accumulation. The fundamental narrative was compelling. Phase 2 accelerated from 2010 into early 2011. Silver rose from $17 to nearly $50 in less than 8 months, a 3x gain. Speculative interest exploded. Retail investors bought aggressively. Phase 3 reached its extreme by late April 2011. Commitment of Traders data showed managed money net long positions at all-time highs. Open interest was at record levels. Every metric flashed extreme. Phase 4 arrived on May 1st. The CME Group raised margin requirements on silver futures. By itself, this might not have been significant, but they raised them again on May 3rd, again on May 5th, again on May 9th, again on May 12th. 5 margin increases in 8 trading days. Each increase forced leveraged traders to either deposit additional capital or liquidate positions. Most liquidated. Phase 5 was brutal. Silver fell from $49 to $33 in the first week, a 33% collapse. It continued falling to $26 by late June. Billions in speculative value was destroyed. The same pattern, the same mechanics, the same outcome. Verified. Example 4. April 2013. The gold flash crash. Gold. Friday, April 12, 2013. Gold had been consolidating around 1,450 for months. The market was quiet, complacent. Then someone sold. In the span of minutes during Asian trading hours, an enormous sell order hit the market. Estimates suggest 100 tons of paper gold, $4.5 billion notional value, dumped into a thin market at a time designed for maximum impact. Gold dropped $30 in minutes. When New York opened on Monday, April 15th, the selling intensified. Another massive wave, estimated at 300 tons. Gold crashed through $1,500, through $1,400, eventually hitting $1,320, a $200 drop in 48 hours, the largest 2-day decline in 30 years. What triggered it? The phases were in place. Speculative positioning had been elevated. The market was vulnerable. The concentrated selling provided the trigger. Phase 4 and Phase 5 compressed into a 2-day event. Who sold? The data shows large commercial traders covering short positions as speculators liquidated longs. The mechanics worked as they always do, just faster. Gold continued falling, eventually hitting $1,180 by late June 2013, down 38% from the 2011 high. Same 5-phase pattern, compressed timeline, verified. Section 4, what just happened? Decoding the current crash. The setup, all-time highs created complacency. The positioning, record speculative longs. He triggers, multiple catalysts converging. The speed. Why this one felt different. Now let me explain exactly what just happened in the current crash. Gold had reached all-time highs. The fundamental narrative was overwhelmingly bullish. Central banks were buying at record pace. De-dollarization was mainstream news. Geopolitical tensions were elevated everywhere. Phase 1 had been building for years. Since the 2020 pandemic response, since the inflation surge, since governments revealed they would print unlimited money to solve any crisis. Phase 2 accelerated through recent months. Gold broke through resistance levels. Silver surged. Headlines turned euphoric. Analysts raised price targets. Retail investors piled in. Managed money long positions grew week after week. Phase 3 reached its extreme just before the crash. The Commitment of Traders report showed managed money net long positions approaching levels that had preceded every previous major crash. Commercial short positions expanded to multi-year highs. The market structure was identical to pre-crash setups throughout history, but nobody was talking about it. Everyone was focused on fundamentals, on central bank buying, on debt levels, on inflation. The positioning data was screaming warning. Almost nobody listened. Phase 4 arrived when multiple triggers converged simultaneously. First, the US dollar strengthened sharply. Dollar strength historically pressures dollar-denominated commodities. This was the surface-level explanation media focused on. Second, interest rate expectations shifted. Economic data came in stronger than expected. Fed rate cut expectations were pushed out. Higher real rates reduced the attractiveness of non-yielding assets like gold. Third, key technical levels broke. Algorithmic trading strategies that follow momentum received sell signals. Systematic selling amplified the downturn. Fourth, and this is what most people missed, large concentrated selling appeared during low liquidity trading hours. Significant volume spikes occurred during the sharpest price declines. The pattern of selling was consistent with intentional liquidation rather than organic profit-taking. Phase 5 accelerated from there. Leveraged speculators faced margin calls. They sold. Prices dropped further. More margin calls triggered. More forced selling. The cascade intensified. Silver, being more volatile and more heavily traded by speculators, crashed even harder in percentage terms. The mechanical dynamics amplified silver's decline relative to gold. This is why the crash felt so violent, so sudden, so unexpected, because the setup had been building invisibly. The extreme positioning was there. The trigger events merely released the stored energy. It wasn't random, it wasn't unpredictable. It was the 5-phase pattern executing exactly as it has for 50 years. The only shock was to those who didn't know the pattern existed. Section 5. Objection handlings, but fundamentals are strong. Why that doesn't matter. Gold is money, it shouldn't crash. Paper versus physical. This was manipulation. What the data actually shows, the crash is over. What history says about bottoms. I know what some of you are thinking, but the fundamentals are incredibly strong. Central banks are buying. Debt is exploding. This crash makes no sense. Here's what that argument misses. Fundamentals drive long-term trends. Positioning and leverage dynamics drive short-term price action. The two operate on different timescales. You can be absolutely right about the long-term fundamental story and still get destroyed by a short-term leveraged liquidation event. Every single crash I showed you occurred during periods of strong fundamentals. 1980, inflation was raging. 2011, money printing was unprecedented. 2013, debt was growing. The fundamentals didn't prevent the crashes. Gold is real money. It shouldn't crash like this. Physical gold held outside the financial system is indeed a store of value, but the price you see quoted is determined by paper markets, leveraged paper markets, and leveraged markets crash. All of them. If you own physical metal for long-term wealth preservation, paper price crashes are noise. If you're trading leveraged positions, crashes are existential events. This was clearly manipulation. They suppressed prices intentionally. There's documented evidence of misconduct in precious metals markets. Banks have paid billions in fines. This is public record. However, the 5-phase pattern I've described doesn't require manipulation to function. Speculative excess, followed by forced liquidation, is a natural market dynamic. It happens in every leveraged market: stocks, bonds, commodities, crypto. Blaming all losses on manipulation prevents you from understanding the legitimate mechanics. Understanding the mechanics lets you prepare. Section 6. What to do now. Practical steps. 1. Monitor COT positioning weekly. 2. Reduce leverage when extremes appear. 3. Separate physical accumulation from trading. 4. Size for volatility, not hope. 5. View crashes as information. 6. Have predetermined responses. 7. Focus on the long term if holding physical. So what do you do with this information? First, monitor the Commitment of Traders data. It's published every Friday, free, on the CFTC website. When managed money net long positions reach historical extremes, crash risk is elevated. This won't tell you exactly when, but it tells you the setup is in place. Second, reduce leverage when extremes appear. If you're trading with leverage and positioning data shows extremes, either reduce size or tighten stops. Don't be maximally exposed at maximum risk. Third, separate physical accumulation from paper trading. These are different activities with different time horizons. Physical metal is for long-term wealth preservation. Paper trading is speculation. Don't confuse them. Fourth, size your positions for volatility that actually occurs, not volatility you hope for. Precious metals can drop 30% to 50% from highs. If your position size can't survive that, you're overleveraged. Fifth, view crashes as information, not just losses. After speculative positioning is cleared, better entry points often emerge. Having capital available during crashes creates opportunity. Sixth, have predetermined responses before crashes occur. Decide in advance what you'll do at various price levels. This prevents emotional decision-making when prices are plunging. Seventh, if you're accumulating physical metal for long-term reasons, ignore short-term paper price volatility. Your time horizon should determine your emotional response. Decades-long holders don't panic over weeks-long crashes. Section 7. Conclusion. The pattern continues the truth. This crash followed the exact blueprint. The advantage. Now you know what to watch. Next video, Central Bank Gold Buying Decoded. Subscribe. Join the silent economy. This is the silent economy. What you just learned isn't secret. The data is publicly available. The pattern is documented in decades of history. The mechanics are understood by those who study market structure. But almost nobody looks. That's why crashes seem to come from nowhere. That's why everyone acts surprised. That's why billions in wealth are destroyed by events that were entirely predictable. Now you know the 5-phase pattern. Now you know where to look. Now you have an advantage that most precious metals investors never develop. This crash followed the blueprint exactly. The next one will too. The only question is whether you'll see it building or be caught off guard again. If this analysis was valuable, subscribe and hit the notification bell. Next week, we're decoding why central banks are accumulating gold at the fastest pace in recorded history, what they understand that retail investors don't, and what it signals about the coming monetary shift. Drop a comment below. Tell me your experience with this crash. Were you prepared? What will you do differently next time? I read every comment. The pattern repeats because human nature repeats. Fear, greed, leverage, forced liquidation. The same cycle throughout history. Your job is to see it. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.